Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
All right, I'm Michael Hartzman. Today is Tuesday, October 19th, 2021, and I'm on as always, with my partner, Dominick Tavella. How are you, Dom?
I'm doing great, Mike, and I wish always, but every once in a blue moon, I think I missed one of these. So I appreciate when you do them on your own or with a little assistance from our team, but I'm happy to be here tonight.
No problem. We had Eric sit in capably last week, but we did miss you, and we're happy to have you back.
I heard you guys did a great job, so thanks to you and Eric for that assist.
Thank you for that. So, since last Tuesday, the market had a little bit of a bounce back, a little bit of a reprieve. We've gotten some good earnings. We've talked about this since we started the show in the beginning of the year. The market does seem to be pretty resilient. But Dom, the I word seems to be creeping into the conversation more and more and more. And that, of course, is inflation. So that seems to be the storm cloud that's forming over the market and may not go away anytime soon.
Yeah, so Mike, and I apologize because, again, I wasn't here last week, and I assume that you and Eric discussed it. But, we had been calling for a pullback in the market somewhere between 5 and 10%, and how we had put some cash on the sidelines, expecting that pre-earnings season, we might get a pullback. We traditionally get a pullback this type of year. And sure enough, we got it, right, Mike? I mean, almost spot on. The major indices were down 6-7%. And then spot on when we started to get earnings season in anticipation of good earnings season, the market has turned around. So far, it's very early in the process. We've gotten pretty good earnings of the companies that have reported. I would argue even better than some analysts had expected. But the big I word and inflation, and God forbid, stagflation, is starting to enter our vocabulary. And I think at least through the end of the year, that's going to be probably the headline risk that we're going to look at. So I think you're absolutely right on that one, Mike.
So you mentioned stagflation, and I was fortunate enough to be on a call just before the show with Ben Bernanke, the former head chief of the Federal Reserve, and he was asked about stagflation. I was on listening to Ben Bernanke through the Schwab impact meeting, because we're clients of Schwab, and he doesn't believe stagflation is on the horizon anytime soon. But he did say there's a lot of talking heads on television talking about it, making a lot of people nervous. But he didn't see stagflation on the horizon anytime soon. But certainly inflation is here to stay.
So two quick comments. Mike, you missed the call this morning with our own advisors. And let me tell you, the most common theme that was coming across from our own advisors, which means they were getting it from our clients, aren't you afraid? And it's the talking heads on TV. I think, again, you're spot on. They will talk about how the economy is going to come to a dead stop. Inflation is going to go through the roof. And this fear, and especially with the political environment that we're in, I think might pause here a little bit of the upside to the market, at least on the short run. Hopefully we get that run through year end. But I agree that the economy has way too momentum in it, and there's way too much liquidity, and consumers want to spend. It's hard for me to believe that the economy completely stagnates. So on the glass half full conversation, I don't think the economy stagnates. It slows down, but I don't think it stagnates. But inflation, we had right here on our own podcast, Dr. Siegel, very famous market economist, and he was talking about significant inflation for the foreseeable future, and transitory not being 3 weeks, 3 months, but possibly 3 years. And I think you heard some timeline there as well, Mike, that you might want to bring up.
Right. Dr. Bernanke said that he thinks inflation is going to be with us at least through the second half of next year, not as pessimistic, although I'm not crazy about that word, but pessimistic as Dr. Siegel is. I think Dr. Siegel is being realistic in his own view, but he thinks inflation will be here at least through the rest of this year, through the better part of next year, and maybe start to abate in the second half of next year. And just to put a bow on what stagflation is, Dom, stagflation is higher interest rates and lower prices. And to your point, there's not any real possibility of having lower prices or lower growth, I should say, anytime soon. Lower growth anytime soon.
So we're going to come up on our cutoff point here, and we have a terrific guest coming up. I'm going to let you do the introduction, Mike, but this is going to be a key focus for us and our advisors and our portfolio managers, at least through the end of the year. I don't believe inflation goes away anytime soon. So how do we allocate it for it? How do we protect our clients' interests going forward? And again, with the worries that are out there, the headlines, the talking heads on TV, big issue for us to pay attention to.
And so with that note, we have this evening Mary Lisanti, who's the founder of the Lisanti Capital Growth Company and the Lisanti Fund. She founded both in 2003. She's been on the show before. She's a super smart woman. We're looking forward to getting her views. And on the other side of the break, I think you have an exciting announcement about our relationship with Mary and how it's about to become a little bit more formalized. So on that note, we will be right back after this break.
Are you paying federal taxes on your cash? I work hard for my money that I keep in cash. And for the life of me, I can't imagine why anyone would want to pay federal taxes on their cash. That's why I keep my cash in the Lebenthal Ultra Short Tax-Free Income Fund, symbol LETAX, le tax.
Rates on cash are already so low, why pay federal taxes on the interest your cash earns? Remember, it's not what you earn, it's what you keep. The Lebenthal Ultra Short Tax-Free Income Fund, LETAX, may help you earn more on the cash you've worked hard for and keep more after-tax dollars in your pocket. Find out more about the fund by speaking with a Lebenthal Global Advisors private wealth advisor or its sponsor at dcmadvisors.com.
For your hard-earned cash, why pay the tax when there's the tax?
Lebenthal Ultra Short Tax-Free Income Fund. It's not what you make, it's what you keep. Before investing, you should carefully consider the fund's investment objectives, risks, charges, and expenses. This and other information is in the prospectus, a copy of which may be obtained by calling 800-441-7031. Please read the prospectus carefully before you invest. Investing involves risk, including loss of principal. There is no guarantee that this or any investing strategy will be successful. An investor should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The fund is distributed by Ultimus Fund Distributors, LLC, member FINRA. The fund may invest in municipal securities, the interest on which may be subject to federal alternative minimum tax. After the fund buys a security, the IRS may determine that a bond issued as tax-exempt should in fact be taxable. There is no affiliation between DCM Advisors, LLC and Ultimus Fund Distributors, LLC. DCM Advisors and Ultimus Fund Distributors are not affiliated with Lebenthal Financial Services, Inc. or Lebenthal Global Advisors, LLC.
All right, I'm Michael Hartzman, back with Dominick Tavella. And some of the joys of streaming this podcast live is we lost Mary Lisanti's connection temporarily. She'll be right back with us. But Dom, in the meantime, why don't we talk about quickly the relationship we have with Mary? We've used her fund. It's been in our models for years. She's made our clients a lot of money. But why don't we talk briefly about how we've recently gone deeper with that relationship?
And I think we may have Mary back. Is that you, Mary?
I'm here. Yeah.
Terrific
Mary.
timing. That was perfect. I know it's a tough making a connection from Ireland, but we're grateful that you can join us this evening. So real quick, Mary, and then love to jump into the meat and potatoes. As many of our clients and viewers know, the Lisanti small mid-cap portfolio has been a core holding of ours for years, and you've done an amazing, tremendous job, and we thank you for that. And I will remind our viewers and our clients that Mary was voted mid-small cap money manager of the year last year. Did I get that right, Mary?
The mid-cap product that you are going to use was voted the product of the year by the emerging manager community. Yeah.
Fantastic.
Congratulations.
Congratulations on
Thank
that. So the formal next step for our relationship, Mary, and again, you can elaborate on it, is we've created custom models where our clients would own the individual securities, the individual stocks in that small mid-cap space. And Mary will lead be the lead money manager on those. We, of course, execute all the trades here and run the portfolios here, but Mary and her team will be the portfolio managers for that. And this is a scenario where our clients could get literally hands-on individual portfolios customized for Lebenthal. So I think that's an exciting news that we can now spread and let our own clients know that this is available for you.
Great. Thank you.
So you're welcome to elaborate on what that role is going to be, Mary, and how you do your research and how we create the portfolios. And then we'd love to switch gears and talk about what's going on in the real world today.
Sure. So as you know, we've been doing this a long time. I've been in the business approximately 40 years. Of course, I started when I was 2. And I'm joined by a team that's almost as experienced as I am. And so we've been small, mid-cap specialists for decades. And the way that we approach it is the heart and soul of what we do is fundamental research. So we spend our days talking to company managements. And we have a very specific approach. We ask a lot of questions to get a sense of how a company is going to be able to grow, the rate at which it's going to be able to grow. And then we really want to understand, we call it, what do you want to be when you grow up and how are you going to get there? And so we want to understand how the company is going to go from tiny to small to mid to big. And then we sit down and we basically draw on our experience. We talk to each other and we look and say, okay, maybe they might have trouble with this issue. Maybe they're going to be able to see an acceleration as they do this. And so we watch for signposts along the way where things could get better than people expect or things could get worse. And then we have a valuation discipline. Because again, you want to be risk aware. And so we will basically sell stocks when they get too expensive. We give them a lot of room, but there are points, as you know, in the market where things can get to the point where the risk reward is poor. And so we want to be conscious of that. And we're really trying to deliver consistent returns. We define growth really broadly. And that's what's interesting about small and mid-cap companies, is that they can be in many stages of growth. So half the portfolio, or a little bit more than half, is going to be in what you would call secular growth stories. These are companies that are transformative, they're disruptive, they're fascinating, they grow really fast, but they can be very volatile. And if they have a problem, it could be a huge problem because they're not cheap. You know, relative to their growth rates, they are, but relative to the rest of the market, they don't tend to be inexpensive. So we balance that with 2 other kinds of companies, what we call structural growth companies. And these are companies that are growing faster than the market they're in because they're doing something different. Usually we call it self-help. So they either have a product strategy, or they have a way to approach the customers, or they're good at making acquisitions that enables them to grow very consistently, a little bit faster than the market that they're in. So they usually grow about 10 to 15% on the top line, a little bit more on the bottom line. And they tend to be very quiet. They tend to go up consistently in line with earnings growth. And they balance these other companies that grow very quickly but can be volatile. And then the last piece of it is what we call transformational growth companies. And these are turnarounds. Now, small company turnarounds are not like big company turnarounds. Most of the time, somewhere along its growth path, a company is going to get out over its skis. And many times it's the biggest thing a management team has ever run, and they're not quite sure how to get to the next level. So many times it requires a new management to come in, basically with more experience, and help it get back on the path. When that happens, people get very emotional. They hate the stock. They don't want to own it. And we know a lot of these management teams that come in and turn companies around because there are serial entrepreneurs that love to come in and fix small and mid-sized companies. And so we follow managements. We have screens where we look for new managements. If they're successful, they turn the companies into growth companies again. And we have a lot of those in the portfolio that started out as transformational growth stocks that are now once again growth stocks. But at the stage at which we invest in them, they really are adding value to the portfolio, irrespective of what the market does, because what only matters is what their particular prospects are and how well they execute. And it's a time where you can have a lot of opportunity for not a lot of risk if you're willing to do the work. And again, we were all trained as fundamental analysts, so it's what we love to do. So when you put it all together, it gives you a very consistent approach and disciplined approach to the small and mid-cap market.
That was probably one of the most thorough explanations we've ever heard of that category. Thank you.
You're welcome.
Mary, one of the things I love about this category is that with obviously dealing with smaller mid-sized companies, and the big companies come along and swallow them up, right?
Yes.
Because they have
Yes.
some kind of cutting edge or growth or technology that makes them very attractive. So talk about how many of these companies in your portfolio don't end up staying there because somebody comes along and acquires them.
Yeah, it's a good and bad problem to have because we hate saying goodbye to them, but it's pretty routine that we'll have at least a couple of takeovers every year. And, when it happens, they usually go with significant premiums. So the last one that we had in the portfolio was Myocardia, which was acquired at a significant premium, I think just about 4 months ago. And it happens in every sector. It happens consumer companies, tech companies, healthcare companies, med device companies, biotech companies, industrial companies. And I think if we're going into the kind of environment I think we're going into, it's probably going to accelerate a little bit because when growth is a little bit harder to come by, all right, the big companies tend to want to buy. And when innovation is harder to come by, the big companies really have to buy it. And, when you talk to younger people today who are coming out of college or graduate school with the skills that are needed, either in drug development or healthcare or technology, or even consumer marketing, they don't want to work for a big company. They want to work for a small entrepreneurial startup. So sometimes just to get the people, these companies end up being acquired. So we think it's going to continue. And again, we hate to see them go, but it usually ends up in significant premiums for our investors.
Mary, on that note, sometimes they don't get swallowed up. Sometimes they just grow up like Netflix, right?
Yes. Yes.
Or Peloton. I'm sure Peloton at the moment is not a large cap company yet, but they seem to be heading in that direction. So what do you do with and I'm not implying you ever own Netflix, but that's a good example. What do you do with a company like that who grows up and becomes this mega successful company and you guys still love it, but clearly it's outgrown your category?
Right. So it will eventually have to leave us. And what we do basically, Michael, is we give them a lot of room. All right. The range in the index, which is our benchmark, is very wide. So mid cap companies go from 500 million in market cap. I think the biggest one in the index is about 32 billion. Wow. So you got a lot of room, basically. So we let them percolate until they really get too big, and then they have to leave us, unless they get too expensive as well. And then basically that would trigger something early. But as they're growing, we are looking for the next replacement. So sometimes we'll cut it back as it gets bigger, and we look for the next replacement. Because what happens inevitably, Michael, as they get bigger, is the growth rate slows. Mm-hmm. And they get widely owned. And then we don't really have an edge anymore. And so we want to find the next one. And it does happen. Again, it's an unfortunate part of what we do, But again, we want to find the next undiscovered company that will come in. And
Mar- Mary, as a follow-up question to that, and I hope not putting you on the spot, could you
No.
give our listeners an example of a company that they may have heard of that grew up in a company that you were kind of watching and nurturing go through this process? I apologize for putting you on the
no,
spot.
sure. So I'm not sure that they would be companies that they would have heard of. But if I think back on the last one that we had to sell because it's too big, and I just want to get the name of it right. So it's a company called Cloudflare, and Cloudflare basically is a software company that provides a platform. Wonderful company, but unfortunately, it got a little bit too big and it got a little bit expensive. I think Cloudflare's market cap now is about $52 billion. And so, that's not a small and mid-cap company anymore. And so what we replace, it's $54 billion as of today.
Wow.
So
But
what
Mary, isn't that really the advantage of this kind of a portfolio that, you look at the number of analysts on Wall Street that follow Apple and Google, right? It's gazillion people are looking at these companies every day. But when you get into this very small mid-cap space, I love that we have to struggle to recognize a name because you're doing the research, you're doing the homework, and the average analyst, the average person on the street is not, right? They're not looking at this space.
No, they're not, because again, and the other thing that we find is even if they are looking at it, they don't come with the perspective that we have. They might be focused on the next quarter, they might be focused on what is guidance. We're focused on what can the company be, because that's really how over time you make money for people. It's when they turn into the next Microsoft or the next Netflix or and they're on that path. And so, one of the companies that we think is on that path that we own in the portfolio is a company called Sprout Social. And it was founded by the people who founded Facebook. And it basically what it does is it helps people go out there and really manage all the social media that they have. So if you think of a Pepsi or you think of a McDonald's and you think of how they connect with their customers, all right, they're on Facebook, they're on Twitter, they're on TikTok, they're on Instagram, they're on all of these things, and they're placing all this stuff around and they're trying to manage all this social media. And Sprout Social enables them to basically do this. And, it's sort of a new category that's come up because it's really a new way of doing things. And they really provide a platform that helps you measure and place things and just sort of manage the whole process. And so this is the wonderful thing about small and mid-cap companies, is they are constantly doing new things in new ways. One of our favorite companies is a company called Corny Digital. I'm sure you've never heard of it, but it's revolutionizing the way that fabric is made. So, we've traditionally woven fabric, all right? And particularly if you have a pattern or whatever. And so to make it economic, companies have to order tons of it, all right? Which is why every time Macy's has red pants, so does Altman's and so does Bloomingdale's. Everybody's got red pants because that's what they made. They made red material, or they have a certain kind of pattern and it shows up every place. Corny enables you to do this digitally. So you can do very short runs. You can change very quickly. You can personalize, and it uses about 10% of the water that the traditional product uses. So it's ecologically friendly, it's environmentally friendly, and they really are revolutionizing the business. So they started out working for Amazon, and they basically have added a number of companies. They do some work with Nike, they do some work with another of other companies where they're basically helping them bring out products. And they brought in the founder and the man who'd run it for a long time. He retired, he brought in somebody from a bigger company to really help them get to the next level. And this is common. You see this commonly. And so he's really been helping them expand the market and evolve. And it's sort of fun to watch them from, a little company that just worked with Amazon to basically make t-shirts and stuff and some of the Amazon vendors to what they've become, which is really revolutionizing, the fabric business.
Well, that really is the definition of disruptive technology, right?
Absolutely.
So, how do you go about, and your team go about finding these little companies that are shaking it up?
Well, there's a lot of different ways. First of all, as I said, we run screens. All right. So there's probably about 5,000 companies in our market cap range, and we'll screen on a bunch of different metrics. So there's an old formula that was called the Dupont Formula that tells you how well a company is managing a business, but it also shows you the different pieces. And so we're not just looking for revenue growth. We might be looking for a company that's improving profitability, or we're looking for a company where they're improving their cash flow, because particularly if they've been troubled, this is oftentimes the first sign of things getting better. And then 6 to 9 months later, revenue growth will start and profitability will start to improve. And remember, small mid-cap companies, all right, several things can happen. The traditional route is they start out small, they grow to be big. But sometimes they can do things to themselves where they stumble and they come, down in market cap and they fall into our market cap range. Sometimes things are done to them, like the pandemic, where basically, a number of companies got their market caps, crunched, and they came back into our market cap range. And so there's a lot of different kinds of companies that can end up in small and mid cap, and we look at all of them. And
Mary, I just want to jump in on Mike's question because we're running up on our break. So do you look at market sectors at all? Do you look at, hey, we want to be so much of our portfolio in the medical or in intellectual property or technology?
We look at it as a risk control method. We want to be careful that we're not tilted too far to one sector. We don't want to run a sector fund. So we want to be balanced, but we'll look at anything that we think basically makes sense. And, we even own a couple of energy companies because the truth is we haven't been drilling wells. And so we're tight energy. So the companies that have energy, they're going to get price increases, and that to us is going to last for a while. So we'll really look at anything. And then the other thing we do is we look at companies when they come public, because you can do a lot of research on them. You look at the prospectus, you meet the management. We may not own them, okay, but we're going to take a look at them because you never know when you want to own them. And we think that's another way. And then companies come to New York for all sorts of reasons, right? They come because basically they're going to Europe. They come because they got to see their lawyers. They come for a lot of different reasons. And we basically meet them when they come to the city, when they come to New York.
Great. Mary, we spent the first part of the show getting really granular with your process and your fund. When we come back, we're going to talk about the market more from 50,000 feet in the air and get your views on what Dominick and I talk about on the open, inflation and stagflation, and how that affects the SMID cap category as well. So we will be right back after this break.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets. Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with my partner, Dominick Tavella, and our special guest this evening, Mary Lisanti. Mary, we got very specific about your fund, and as I said earlier, you did a great job explaining the category. Let's circle back to where Dominick and I opened the show and talk a little bit about inflation, stagflation. I would assume if inflation is coming or here already and here to stay, that adds another challenge to your category in these smaller businesses and pricing pressure and the cost of goods and services going up. So two-part question. First, talk about inflation in general, and then, how does it affect the small and mid-cap category?
Sure. So I think maybe an important distinction And we do keep talking about it as inflation. I tend to think of it as reflation. So if you think about it, it's a period where basically, I believe, pricing power will come back, particularly to public companies. All right. And that's really the key, I think, to the market. It won't come back evenly. All right. Companies are going to have value-added services and products to be able to raise prices. But for the first time in a long time, that's what we're starting to see. So while there are cost pressures and there are labor pressures, the ability to raise price and the ability to use technology to improve productivity is going to be a tide that mildly lifts margins and lifts revenue growth. And we haven't seen this in a very, very long time. I would say basically that if you go back, so the 30s into World War II were a period of deflation. And then coming out of World War II into the early 60s, we were in reflation. That was a really good time for stocks. All right, we've just been through a period of deflation. All right, it's probably lasted about 15 years, from 2000 to probably 17, 18, 19. Now we're entering a period of reflation. And, if it works the way I think it will, it might over the next 5 to 10 years, you're going to different companies are going to handle it differently. And so it's going to be much more about stock selection. But the companies that can manage it and can raise prices are going to do really, really, really well, better than people think, because we have a whole generation of people in the market that have never seen reflation. They've only seen disinflation and deflation, and they have no concept of what happens when companies can take price. But it's very powerful.
Mary, that's assuming that the consumer or business owner is willing to actually pay up, right?
Right.
And that businesses can actually pass on that increased cost to the consumer, right? So it's a double-edged sword here. So we just saw retail sales and the number looked positive on the surface, but then when we dug into that number, gasoline prices had gone up so much that they actually looked on the surface that consumers were spending more money. They were, but not on buying product, a retail product, as much as gasoline prices had gone higher. So that's not a good way for consumers to spend their money. How do companies deal with that?
So I think they deal with it a couple of ways. One of the things that you do basically is, again, you tend to use productivity to help offset some of the costs. And the consumers will spend on things that they think are very valuable. And then you also need to be really close to your consumers. So it goes to micro marketing. And then it helps if you have a value-added product. All right, so if you think about the value of something, you've got to price it well, basically, so that it's valuable. But I do think it's going to be very back and forth, partly because what we're seeing now are some spikes as the economy reopens. We deal with the supply chain. As we talked about with energy, the problem has been we haven't drilled new wells in 3 or 4 years. So as the global GDP starts to pick up, we are tight energy, and we're going to be tight energy for a while. And so it's going to be basically, what's your value to the consumer? So when you look at certain things, what do consumers value? All right, they value things that are perceived to be better for them. All right, they value things that are going to be healthier. They value things that basically experiences. All right, and so, you might not pay more for a loaf of Wonder Bread, all right, but you might pay more for a loaf of organic bread, thinking that you're making it, it's a little bit healthier. So again, it's got to be a sharper message. It's got to be a better value proposition. You got to be close to your customers to understand what that is. That skill set tends to reside more in small companies than it does in big companies, which is why historically smaller companies have done better when you have periods of mild to rising inflation.
So to your point though, Mary, you mentioned, I think the bread example is a good example. People will tend to buy organic bread when it's good for them, if it costs a little bit more money, if they have a few more dollars in their pocket. Mm-hmm. So to Dom's point, if we have inflation that's being sucked up by high energy prices, what's the risk to the economy that they're not buying the organic bread, that they are buying the cheap Wonder Bread? because they don't really feel as affluent as they felt 6 months ago.
So I think there might be some of that. And we have seen instances where companies have raised prices too much. All right. And things have slowed. For instance, in decking, prices have gone up about 16 to 20%. And we've seen a little bit of slowdown in people building decks because basically they're saying that's too much too fast. But you have to remember two things. The consumer has saved through this pandemic. Consumer savings is at the highest it's been in decades. Okay, I think it's about 26% of household net worth. So it's huge. There's a lot of cushion there. And then the second thing I think that's important to remember is wages are going up. For the first time in, again, how many decades, we're seeing wages go up across the board, all right, because we're tight labor. So the consumer is actually getting a little bit more money in their pocket. And I think that's the offset. I think if wages weren't going up, it would be a problem. But, you know, there's a virtuous circle that happens to our economy. If you run inflation at 2 to 3%, you run GDP at 2 to 3%, which is everything goes up just a little bit, and it sort of greases the wheels. And I think as the economy gets reopened, and that may take another year or two, you know, the hope is that we settle into something like that. And it doesn't mean there won't be spikes. And again, companies' ability to manage it will vary company by company. So that to me is the biggest message.
And
It's
Mary,
no longer.
That's the value proposition of having you, right? When
Yeah.
we're looking at, and I don't want to throw out specific company names, but if you're looking at an airline that has a great deal of fuel costs, right, as part of their
Right.
component, we just saw one of the largest in the country announce that next quarter's earnings were not going to be that great because
Right.
fuel costs had gone so high. And of course, their capacity for number of people flying has not gone up as much as they had hoped. So
Right.
stock selection here is really going to make all the difference in the world.
I think so. And you're right. If you're just a plain generic airline, it might be a problem. If you're a company that happens to package vacations for people in hard to reach locations, and as part of that, you have a plane that takes them to, you know, say from Iowa to Cancun, you might do better, you know, because you're providing a valuable service. So that's part of it, is you've got to have something that's a little special. And I think, again, that tends to reside in smaller companies. And I just think, you know, it's going to be a little bit more up and down for the next couple of years as we deal with inflation returning, as we deal with these spikes in food and energy, as we deal with just the economy reopening. And again, it's going to basically, I think, make stock selection part of the process. I can't emphasize how significant this is. It's the bottom of inflation. It's the bottom in interest rates. All right. And it's been a 30-year phenomena, almost 40-year phenomena, from 1981, when interest rates hit 21% and inflation was 19, to now, when we basically had interest rates at 0 and we had disinflation. This is going to change the investment landscape, and it's going to be a gradual change, but it will be, I think, a long-lasting change, like a 10-year plus change. And it's going to shift the focus to earnings growth and to revenue growth. And it is going to mean that if you're going to have a high multiple, you better be able to grow fast. You know, we're not just going to give high multiples out willy-nilly because rates are 0. So I think what you're going to see is a market that's more selective in terms of which companies do better. And companies within the same industry will grow at very different rates, depending upon the strategies they have to connect with their customers, to be able to raise prices and to manage their costs.
Mary, to that point of managing costs, how worried are you about the supply chain shortages that do not seem to be going away?
So this is really interesting. And I think this is a great example of how you can do something different. Okay. Again, you see it in semiconductors. We've been tight semiconductors for quite a while. And the truth is, we're going to be tight semiconductors for a long time. All right. So the auto companies have struggled to basically get the semiconductors they need. Right. We have a couple of companies, one in particular, SiTime, which basically use the semiconductor shortage as a way to gain significant market share. All right. What SciTime does is they make chips that are timers. All right. They're called clocks. They're in every computerized system, from autos to PCs to servers to phones to watches to everything that's got a computer in it, microwaves, dishwashers, everything. Basically, you have to have a timer. You have to have a clock. And so SciTime's biggest competition is people make it internally because it's not very expensive. Their stuff tends to be higher end. They make it differently. They tend to use quartz crystal and some optics because you get better throughput. But they saw it. They've been in the business. This is the third company or fourth company these guys have started. So they've been in the business for like 35 years. So they saw this coming. They basically went and they got extra capacity. They paid a premium for it. So they were able to take huge market share because everybody looked at this and said, well, we don't want to use our semiconductors to make these clock things, timers. Let's go to SciTime. So they gained market share, had a huge spike in earnings. All right, I'm talking about they almost tripled the company as a result of this strategy. And that's a really dramatic example of how a company management can take a crisis or take an issue and make it an opportunity. And again, you tend to get it in smaller companies because they're more flexible, more nimble, they can react more quickly, and they can really respond to these things. They took lemons and they made big lemonade, basically. So.
Mary, in one of our earlier conversations, you talked about focusing more of your portfolio US, which is kind of contrary to what we've heard from other money managers, that now might be the time to increase your international exposure. So I'm really interested in your views on that.
So I think it depends. When newer companies tend to do the supply chain quite differently, I guess what I'm thinking about is the big multinational companies that have global supply chains are going to have trouble because what we've just seen is you cannot run a just-in-time supply chain as tight as you had in the past, right? Because these issues are not going to go away. All right, we're not going to wake up and see some of the emerging market countries all of a sudden everybody gets vaccinated and life is back to normal. It's not going to happen. All right, we're tight people over there. We're tight ships on the ocean. We're tight port capacity. We're tight longshoremen. We're tight a whole bunch of things that aren't just going to go away. And so you're going to have continued bottlenecks and continued stop and starts. And I think, when you combine that with the rise of nationalism, all right, and some political issues that are coming up, some tensions that are arising between countries, I think what you're going to see is it's just, you're going to have to build in some slack to your supply chain. That's going to be more expensive, right? Whereas the little companies can approach it from a very different way. And so by more domestically focused, again, these companies tend to have more of their business domestically. But if you think about it, all right, the US has been ahead of the world in support for its consumer coming out of the downturn. It has a supply of energy. Right. The last time we had this increase in oil prices, German GDP went to zero because they import everything. All right. And so there's much more vulnerability in the rest of the world to these energy spikes and these food spikes than there tends to be, believe it or not, than there tends to be in the US. And so I think the US will probably end up in better shape for a long time than a lot of these other economies. And that's just what we see.
Mary, we are less than a minute to go. So we just want to thank you. Thank you for your insight. And I guess the bottom line is when it comes to small and mid-cap space, it's all about discipline. To quote Kenny Rogers, know when to hold them and know when to fold them and know when to get out when the getting is good.
Yes, thank you for having me. I very much enjoyed it.
Thank you, Mary.
Very grateful for our past relationship and very much looking forward to us working together going forward.
Thank you.
We'll be right back.
When you're thinking about where to park your cash,
For over 30 years in the business, I've been a fan of funds like the Lebenthal Ultra Short Tax-Free Income Fund. It's managed for cash and designed so the interest income you receive is free from federal taxes. And who doesn't love paying less taxes?
Mike, generating interest that's free from federal taxes is appealing, but I've been in this business for a long time, and people love the potential for more income on their hard-earned cash.
Sorry, Dom, but the beauty of the fund is paying less taxes on cash.
No, my friend, it's the potential for more income.
Less taxes.
More income.
Less taxes.
More income.
Less
For your
taxes.
cash,
More income.
ask your advisor
Less
about the Lebenthal
taxes.
More
Ultra
income.
Short Tax-Free Income
Telling you,
Fund,
less taxes.
or find out more at dcmadvisors.com.
Well, Dom, one thing I know we agree on, it's not what you earn.
It's what you keep.
Lebenthal Ultra Short Tax-Free Income Fund, symbol LETAX. LETAX. Before investing, you should carefully consider the fund's investment objectives, risks, charges, and expenses. This and other information is in the prospectus, a copy of which may be obtained by calling 800-441-7031. Please read the prospectus carefully before you invest. Investing involves risk, including loss of principal. There is no guarantee that this or any investing strategy will be successful. An investor should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The fund is distributed by Ultimus Fund Distributors, LLC, member FINRA. The fund may invest in municipal securities, the interest on which may be subject to federal alternative minimum tax. After the fund buys a security, the IRS may determine that a bond issued as tax-exempt should in fact be taxable. There is no affiliation between DCM Advisors, LLC and Ultimus Fund Distributors, LLC. DCM Advisors and Ultimus Fund Distributors are not affiliated with Lebenthal Financial Services, Inc. or Lebenthal Global Advisors, LLC.
All right, I'm Michael Hartzman, back with Dominick Tavella. And Dom, I think Mary summed up really well what the small and mid cap space is all about, and really what it boils down to is stock selection. Even to your point today about today's activity in the market, we look at the winners and losers. 6-7 months ago, everything went up. It didn't matter, and now with some storm clouds coming, stock selection I think is becoming really critical.
Yeah, and look, Mike, I thought Mary was a terrific guest and really was spot on with her commentary. It really comes down to a very company specific argument of whether the companies are going to be able to deal with inflation and be able to absorb some of the cost increases or pass some of those cost increases on, or they're just going to get shoveled under by it. And there are industries, and I don't want to pick on any here out loud, but you can kind of think of this on your own, where these input costs have gone up so hard, so fast, it's going to dramatically affect their earnings, and maybe for quite a while. And so stock selection is critical here. Don't own this stuff. Don't have it as part of your portfolio.
And I just want to emphasize that Mary Lisanti's fund and Mary Lisanti's skill set has been a part of our models for years now. And it's not a new relationship. She's done very well with our clients. And now we're fortunate enough where those clients who want to own those individual companies that Mary's doing the research on, we're now making available to our clients as well, which, Dom, is kind of a big deal that Mary's willing to do that for our firm.
Yeah, and look, we have a pretty significant relationship. We're pretty big investors in her fund. We did just knock on our door as strangers. We've known each other and worked together for quite a long time. And when we approached her about creating a custom portfolio that our clients could have the individual stocks being bought and sold and traded and managed by her firm, she was very receptive. She didn't have to be. She didn't have to come in on this one for us, but she was very gracious, and we've always treated her well over the years, and her as well with us. And having this ability, I think it really is terrific. It's just something special, and I am definitely looking forward to having a long-standing working relationship with her.
Yeah, it truly is. It truly is a value added. And to that point, as we go along in this market cycle, having people like Mary in our corner is really extremely helpful. I mean, there's no way around it.
And if I don't mind me adding to that point, Mike, it's not just about the fund and it's not just about this portfolio she's going to build with us, but having her insights like she just shared with us on this podcast. And I'm looking forward to sharing this with our clients, having her insights about where sectors or inflation or international versus domestic. I mean, she's always open for us picking up the phone and having these kind of conversations with her. And hopefully she'll join us in the future again, but having her and other portfolio managers like her available really helps us tremendously.
And really the real skill set for her, and you mentioned it earlier, she's not just buying Apple and Amazon and Google and assuming they're going to go up. What she does and her team does is really picking those winners and losers. I think she said from 5,000 companies and trying to determine, of the 4,900 that are probably not going to make it, and which of the 100 that are going to be transformational. That really is, to me, the remarkable skill that her and her team have in that category.
And Mike, as we love to say, past performance does not guarantee future, blah, 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 right? On the other hand, this is a very experienced, very knowledgeable money manager who's done an exceptional job for a long period of time through down markets and up markets, right? And so her history, her excellence in doing her job, and our relationship going forward, I think is value added to the entire firm.
And just to reiterate how we open the show and how Mary alluded to, if you have the talking heads on TV, all day long, do not get spooked by inflation. Do not get spooked by stagflation. The reality is that the Federal Reserve was hoping for a little inflation, and it's just here now. So you just have to take all this news and all these headlines and put into context and be careful what you choose to believe and hear with your own ears.
Yeah, so the headline, we've talked about headline risks many times, and we're running out of time, so I'll do this quickly. It's stock selection, common sense. It's really about the individual company. Can they deal with this higher cost, input cost, or they can't deal with it? And if they can't, we don't want to own them, right? We don't want to be in that sector. If they can deal with it, they actually leapfrog the competition and prosper. And our job is to kind of make those bets properly so that we're more right than wrong.
And on that note, Dominick, we are out of time. It was a great show this evening. Great hanging with you. And I will see you down the road next week.
This was a fun one. Looking forward to next week.
Have a good night, everyone. Stay safe.
Thanks for tuning in to the Lebenthal Report.